this financial literacy out there to the world. Can y'all see? You see my screen? Somebody give me the okay.
Yeah, I can see it.
All right, cool. Well, the title of my presentation is let me make this full screen. Hold on. The title of my presentation is Why Disney Could Be You. I mean, honestly, what motivated this presentation title is the post that the HBCU Wall Street actually puts out about Disney and how they started with life insurance. I didn't even know that until I saw you guys post, and I saw it a couple of times, and I'm like, how come I don't know this? And so I went back and I researched the story, and the story talked about how Walt Disney took money out of his cash value life insurance to be able to fund his idea, which I think was dope, right? And so what I also did was I went back. I said, I wonder if Disney's the only company that did this. And when I did my research, I found out that they were not, right? And so I'm just going to start this off with showing you guys some of the other companies that life insurance also help, right? So this is just an article right here. McDonald's was one. So Ray, it says right here, Ray Kroc used the cash value from his life insurance policy to buy out two of his partners, the old partners. If y'all seen the movie, I can't think of the name of that movie. It's on Netflix though. But Ray Kroc brought out the original owners of McDonald's with cash value life insurance that he had. So McDonald's is one. J.C. Penney is another. I'm not familiar with Forrester Farms, but apparently they use life insurance, and Pampered Chef as well. And it says here that the company was bought out by. They used a $3,000 policy loan from their life insurance to start the company, and then were bought out by Warren Buffett for 1.5 billion. Pardon me. God damn. That's what you talk about when you talk about a return on investment. So that's dope. So I just want to give y'all that backstory real quick. Now I'll get into my presentation all the way. Let me go back to that. And so just a little bit quickly about Legacy Empowerment Group. The core mission of Legacy Empowerment Group is to close the racial wealth gap for people like all the people on this on this call. Most people on this call, I'm assuming, are about that wealth life at the end of the day. It's 9:00 at night. You guys paid to be here, and you're showing up and listening to advice from people that are trying to help. That's dope. And so Legacy Empowerment Group is built for people like yourself, closing the racial wealth gap, just helping us avoid the major roadblocks that prevents us from creating wealth. And a lot of that is attributed to just poor life insurance decisions or lack of life insurance decisions, honestly. And so our goal was to help put $100 million in the future into the Black to African American households. And we began to track that amount. And so it's a pretty cool thing that we're doing. The way we do it, we're based out of DC. The way we do it, we help. One second. We help you leave a financial legacy for your family, obviously, by leaving life insurance, and then overall educating people also on the retirement planning process as well. Our niche market, because we're in the DC area, and the DC area's middle class is filled with federal government employees. That's our niche. We do a lot with the federal agencies in DC. We've been doing that since 2009. We have over 500. Actually, we're closely approaching 600 at this point. Clients that are in the DC area. Federal government is our big market. We love it because they have a unique problem that face a lot of Black middle class people, which is a lot of people that work for the federal government rely on their life insurance at work. If you know a federal government employee or somebody that's trying to be it, one of the main things they always say is, "I want to work for the government because they got a good benefit package." While they do have a good benefit package, they're severely lacking in the life insurance part of it. And so what we do is we educate people and make sure that they have a good life insurance policy that they can leave to their family. So that's our niche. And our overall goal, no matter who we deal with, whether it's federal government or like some of you guys on the phone, is we want to create the habit of generational wealth. Right now I was at lunch today with a bunch of wealthy white folks, man, and it was hard for me to even sit there because I was thinking about, not even thinking about, I was listening to them talk about money. And to them, I mean, millions of dollars moving amongst each other is nothing. I mean, it's just literally, it's like, it's like, I mean, it's like nothing. Like they just do nothing but business together, and they're just moving money with ease because they have so much money, and they just have a habit of it. And we just have to get in the habit of just doing that, like making sure that okay, our generation is funded. We got a solid trust set up. We've thought about how we're going to pay for our state taxes. We've already thought about how we're going to our succession plans with our business, and I'm sure some of this stuff was talked about in other calls. But just sitting with those guys today, I realized like this habit of generational wealth is something that we got to take deadly serious if we're ever going to compete. Because best believe, and this is something else I've noticed over the last couple of days. Just I spent a lot of time with some white folks. And then last night, a buddy of mine was in town for this APAP conference, which is this Jewish Saving Israel conference, and we were at dinner last night talking about wealth and how the Jews do it. And they're competitive, right? Like they are competing with us, and we're not even trying to compete. We're just begging for money or asking other people to help us with money. But they have strategies around how to be the best and the most wealthiest, like period. Like every other race are competing when it comes to wealth because they want to protect and save their own. And obviously we're doing it as this group on this call. Otherwise, we wouldn't be on here. We'll be doing something else. So I just wanted to speak to that. Just that generational habit of wealth is something we need. Here's a couple of things we're going to talk about tonight. One of the big things we're going to talk about is the racial wealth gap. That's the overarching topic of tonight. It's going to be that racial wealth gap, and then how we close it, one family at a time. But before I do that, I want to talk a little bit about my story, my mentor. How we had a unique conversation in Georgetown one night that shifted my life. I'm going to talk about the racial wealth gap study that was done, and I'm also talk about the history of life insurance and some of the things that particularly impact us that was systematically done to us. So I'll talk about that, and then I'll teach you guys how to act now, and give you guys some motivation to make some decisions that could change your family's life forever. So first, I'm gonna talk about my mentor. Right, it's a really important thing. Sorry if the pictures ain't the best of qualities, but this is the best I could do. We had those janky cell phone cameras back then. But this guy here in the suit, older guy. He's not old. He's in his late 50s here. And that's me and him down in DC. That's his Maserati. He's a ride around town in the Maserati Quadriport, the latest model at the time. And we used to just drive around. On Saturdays, we would drive around town and go to the fanciest restaurants we could find. And he would just mentor me and some other select few guys that he deemed worthy. And he would just teach us the game on Black financial matters. Like, I mean, the emotions of money, the mindset you got to have money, how to protect yourself from your family, all type of stuff, man. I mean, because he was a self-made millionaire from Georgia. I mean, from Central Virginia. And so it's one thing to like read books about people that have made money, but it's another thing to actually sit with somebody and they can take you through the emotions and the things you got to overcome. So that was a phenomenal 3-year process of being able to sit at his feet and really learn the game. So like some of the things that we've done, like this picture I got here with, is an older guy. He was only here for that day. He's from Philly, but the older guy at the table with the white shirt. But these 3 guys here were Anwar was 19, Carlin was 18 from the city, and I forgot his name, man. He's from North Carolina. But these are young guys, man. And we used to take them to these 5-star restaurants and we would just buy bottles of wine. They could order whatever they wanted. And I just remember one night just seeing these guys sit at the table in their suits, just looking good. And I just remember being like, I was like, I gotta take y'all pictures. I mean, because as Black folk, it's so important to expose people to what life could be. And two of the guys at the table, Anwar and Colin, were from the streets of DC. They had never seen nothing like this. And to see them like that was just a big moment. So when I came across this picture, I just wanted to share it with you guys because my whole thing is, it's cool to leave life insurance. It's cool to have a amount of life insurance, whatever. But at the end of the day, it's important that we are mentoring people and showing people what to do with the money when they get the money, and exposing them to new things. And so that was a moment in my life where I was seeing these young brothers being exposed to things they had never been exposed to before. I mean, look at these dudes. They sipping red wine at 18. Like, who's doing that? I know I wasn't. So that's that. The next thing I want to talk about is what motivates me every day, right? These statistics right here. This is the study that was done that showed the racial wealth gap in America. And this study is not done based on people of higher income than others. This is based on the same income level, right? So this is middle class white folks, middle class Latinas, middle class Black people, right? So it's easy to compare, what's a good guy? Mark Cuban to somebody that works in the government, and you can see, okay, well, yeah, obviously white people are going to have more money left because they have so much wealth created. Well, nah, that's not the case. This is middle class white folks, middle class Black folks, all making the same amount of money. This is how much white folks leave. This is how much Latinas leave, and this is how much Black people leave. Now, there's some psychology that goes into this, and I'm gonna get into that later, but I'll tell you a little bit about it now. Is one, Black folks just for years were brainwashed into believing that life insurance and wealth is something that's not supposed to be done. All you need to focus on is like burying yourself. That's the majority of the psychology that I get when I meet with people. I would say the numbers, it's gone down recently, but when I first started, 9 out of 10 people that I would meet with would say, "Hey, Mr. Smith, that's cool, but I don't want to leave my kids rich." Like, I'd be like, "What?" They'd be like, "Nah, I don't want to leave them rich. They got to work hard for it, just like I got to work hard for it." And that was the mentality. You know what I mean? When I meet with white folk, that's not the conversation at all. The conversation is more so like, well, is that all I can leave? Because typically when I'm working with government employees, majority of the time, I set the number at 250 because 250, anything above 250 with the particular carrier I'm talking about, you don't have to take a medical exam. So when I throw that number 250 out to some of the white clients or even Asian clients, the response is that all I can do, or can I do more? Like, it's offense. As far as when it's us, a lot of times it's defense. It's like, well, how much is it going to cost, and why do I need to leave them more than $20,000 or enough to bury me? Like, I pay for their stuff now. I shouldn't have to pay for their stuff when I die. You know what I mean? And so that thinking a lot of times contributes to this this study that was done that shows us, and I read something recently that said it's getting even worse. The gap is getting even wider. So, we got to change that. That's the motivation of Legacy Empowerment Group. I'm all about changing that. The Latinos are killing it. Even while I work right now, I work out of a WeWork in DC, and there's a whole Latino economic foundation or something like that, and they take up a whole line of offices, and they busy in there. And every time I walk past there, I cringe because I'm like, damn, like they got their economic shit together. You know what I mean? And so if we don't get serious, unlike you people on this call, but like others, if they don't get serious, we are going to be left behind. So we gotta get serious about this wealth creation and applying what we learned throughout this summit. So that's what motivates me, the racial wealth gap. I want to show y'all a study real quick. This is an article, and I'll post a link in the chat. But this is an article, and look how old this article looks. But this is a real article from 2004. It's USA Today, and it talks about the industry, the insurance industry faces lawsuits after centuries of race-based charges, right? So if your parents are 50 and above, if you ask them about their parents, your grandparents, if they had a life insurance man that would come door to door and accept life insurance premium, and you grew up in the United States, I'm pretty sure they'll be like, yeah, I remember that life insurance, man. And that's what was going on for years in Black communities. Life insurance men will come door to door, collect premium on a weekly basis, and it would be a couple dollars. But what they were selling is they were selling industrial life policies. And these industrial life policies, what they were selling in the conversation was you just, all you need is enough to bury you. This is whatever, this to take care of whatever. But what they were selling across town in the white neighborhoods were the type of policies I'm gonna talk to y'all about tonight, which are wealth building policies. And so with this lawsuit, and the numbers are here. The lawsuit indicted AIG. This is American General Life, is AIG. They got sued for $250 million in a case involving 9.1 million policies. Think about that. And these policies were highly targeted towards African Americans. They only got sued $250 million for $9.1 million in policies. Then you got MetLife, 2002, $157 million for $1.9 million in policies. Mutual Savings Life, life insurance. I don't know those guys, but they in Alabama. In June, they got sued for $11.6 million. Where else? Who else is in this? I know New York Life is in here somewhere. But a lot of these big insurance companies were sued because they were all in cahoots to sell horrible policies to minorities at the end of the day. Nobody's really been raising a fight about it. It's just low key. You're not gonna hear a lot about it. But this attributes to that psychology that I was talking about when you got that older generation that talks about, oh, all I need is enough to bury you. You know, that's because they were fed that, right? I remember being in this meeting when I was with FCPC, the company that my mentor had, and it was a woman from Philadelphia, and she was old. She was like 80 something, and she came, she stood up, she had her copy of her industrial life policy, and she read it to us. Well, not hers, her mom's. And she had paid, no, it was hers actually. And she'd been paying on that policy for, I don't know, maybe 20, 30 years. And the amount of coverage that it was $5,000. How do you pay on anything for 20, 30 years and the coverage would be $5,000? But these are the type of policies that were all wrapped into this lawsuit, right? But you know, this is what we're fighting against. White people play mental warfare, flat out. Like spending time with them, they play mental warfare and they're ruthless. They don't give a fuck, like just straight up. They are out to make sure they win at all costs. And I mean, to be honest with you, I cannot knock them for that at the end of the day because they're trying to protect their own. We got to be just as aggressive. So I mean, but we ain't gotta be crushing other people to get what they got. You know what I mean? But they are all about crushing them. I mean, keeping themselves as number one. And tactics like this are how they do it, right? So that contributes to us thinking small and they thinking big at the end of the day, because they still made the money from the policy. They made the money, you know what I'm saying? But they kept us small. You know what I mean? You could pay that same amount of money they were paying for the industrial life policy. We could have been buying nice, decent sized term, decent sized whole life policies, and had the type of wealth they had and generated the habit of leaving money. So we just got to reverse that. So that's what we up against. That's just giving y'all some background on like what motivates me. So just to recap, you know, mentor helped change my life. Really taught me the ins and outs of Black wealth, gave me a vehicle that I could sell and I believe in. You know, we help people with the life insurance, but we also help these young guys see a dream. That's just as important as the life insurance. And then we just attack this racial wealth gap and attack that mentality that keeps Black people thinking small, right? So next thing I'm gonna go into is the different types of ways we can act now and change the mentality that's been fed, right? So I'm gonna tell you one conversation, and that's why I put the subway conversation. I didn't go to HBCU, even though I'm on the HBCU Wall Street summit, but I went to the University of Maryland. And so being at the University of Maryland allowed me to have a lot of different type of conversations, right? Because I went to Black elementary school, I went to Black high school, you know, so I was all Black until college. And so when I went to Maryland, I had a conversation with this Indian guy in the statistics class. And, you know, we were just talking or whatever. And I just asked him because we just got really cool. I was like, yo, how do y'all start all these subways, man? And this dude, he had to be no more than 18, 19. And he just broke it down. He's like, oh man, William, when we come to America, we get the big life insurance policy on our aunties, you know, and in that culture, auntie is anybody older in the family. And so they get life insurance policies on the oldest people in their families, and the family comes together and pays it. And so when the person dies, it's immediate flip on the money. Like even Friday night, I got an appointment with a 74-year-old black guy, and you know we're looking to sell him a $300,000 policy. He probably pay into that policy maybe $100,000. He got a lot of money though, so he might pay into that policy $100,000 over the next 10 years or whatever. But when it's done, his family would have gotten $200,000 extra that they would not have gotten if we didn't put that in place. And so, you know, Asian families are doing that all day long. It's a system, and that $200,000 they reinvest that into the system. They put that into the business generates profit, and then you got, you know, this huge amounts of wealth. And it's a system of wealth, you know. And so that blew me away in college, and that opened my mind to, yo, because I wasn't thinking about none of that stuff. All I was thinking about was where we was going to get some drinks after class, or like cheating off his test. You know what I'm saying? I wasn't thinking about nothing on that level, you know. And so like that opened my mind to like, yo, like we got to get serious about this stuff and start teaching our kids how to do the same thing. So that's that. So another question is for you, right? Now we're talking to you guys, like, how much life insurance do you need? That's a question that I often get. And that question varies, right? This is from LIMRA's website. I took this off of there. And LIMRA is the Life Insurance Marketing and Research Association. So they just take data from years and years and years of life insurance cases, and they compile it and come out with the data that makes sense to you and I, right? And so if you have few dependents and few debts, then 7 times your income is a good amount, right? And few dependents and few debts means 1 child typically, and a little bit of debt, right? If you have a large family, 10 times. Typically, I tell my clients at least do 10 times, just because, you know, we fighting from so far behind as Black folks. Like we got. This is for everybody, right? You know what I mean? A lot of times we tend to defer into the, pardon me, into, you know, we typically have a lot of debt because our college isn't being paid for in most cases. And, you know, so we don't really have a lot of money saved for our kids' college in a lot of times. And we didn't get no money from grandma, you know, so we like to stunt, you know what I'm saying? So we don't want to, we just want to make sure that our family can still stunt, can still go to college, and can still live a decent life without us being there. So I tend to defer to the 10 times, you know, but 7 times is just as cool if you can't afford to go 10 times. So that's just a rule of thumb. And so what I do when I meet with clients is I take them through a calculator. I won't do that here, but at the end of the day, the calculator gives us that 10 times number. So if you're thinking about life insurance yourself, just think about what your salary is, and then times that times 10. Especially if you work a job and you don't have any life insurance outside your job. Most jobs, the max they're going to give you is 5 times your salary, and that's going to be double the cost it would be if you did that 5 times yourself. So if you work a job and you don't have 10 times your salary and you got kids, make sure you get the 10 times your salary as soon as possible. Because, and I'm gonna go into this a little later, but it's better to get it now than later because you never know what can happen. And I'm gonna go into that a little later too. I got a good story about that. So these are the different types of life insurance policies that I sell. There's multiple different types of life insurance policies. But I'm only gonna go into what I sell on this chart. I'll tell you why I don't sell others. But you got whole life insurance. Whole life insurance, some of the policy features, it builds cash, it lasts your entire life. Money can be used for your children's college and retirement. It can be used for anything else too, but vacation, whatever. But I just know most people use it for their children's college and their retirement. Um, it's great for leaving a legacy. It's great for building tax-free savings. It's great for older clients, and it's great for children to start them building a wealth at a young age. I know I have a life insurance policy with my children. There's two of them, whole life. The ideal people for whole life is families with kids, families that want to save money for their children's college, people that have medical issues. And what I mean by that one is if there's something called a final expense whole life policy. So if you're on here and you don't have coverage on your parents, and your parents, their health might not be too bad. They might just have high blood pressure and diabetic, right? They're not really going to be able to get a big term policy or a standard whole life policy. They'll be able to get a final expense policy that can go up to $50,000 without a medical exam, because older people are just not trying to take medical exams, and I get it, but whole life works for those people because they won't have to take a medical exam for the final expense whole life anyway. And then also it's good for people that want to leave additional money to put additional money towards retirement and want to leave life insurance at an old age. And with all those features, whole life is the highest price point, but you get a lot of bang for your buck with it though, right? So if you can afford whole life and you're already maxing out your retirement, I recommend you doing it all day long, because you're just going to build a lot of cash, and you're going to have a financial legacy that your kids will have tax free, which is dope, right? And so the next type of life insurance policy is for this example is guaranteed universal life, but there's also regular standalone ULs. I won't go too deep into that, but I'm not a big fan of them because they require so much hand holding, and there's a lot of flexibility with it. And just to be honest, with our people, especially the people I deal with, flexibility ain't good because you give somebody an inch, they'll take a mile. And so with those universal life policies, if you're not extremely disciplined with them, what can happen is they can lapse on you, and I just don't want to see nobody put in 20, 30,000 into something and then it lapse because they just weren't disciplined, or the market changes and I got to tell them, hey, Ms. Jones, I need you to put an extra $400 in this policy, and they can't afford to do it, and we're just sitting there looking stuck, and they know they put all this money into it and they can't get it out. So I'm not with that. So all I sell is the guaranteed universal life policy. This policy will last somebody's entire life. The difference between this and the whole life is it has no cash value. So it lasts your entire life, but it just don't have no cash value, right? This is great for people wanting to leave a legacy, but they just might not can afford a whole life policy. It's great for older clients that still want to leave money for their grandkids again, but just don't care about the cash value or don't have a budget for the cash value. Ideal family with kids. Families don't necessarily care about cash value, but still want to leave money. It's the mid price point. It's in between the term and the whole life. So I sell a lot of guaranteed universal life, just because it solves the legacy need, but it doesn't cost as much as whole life, so people are able to digest it a little bit better. The next thing is term. Term insurance is the cheapest, but it doesn't necessarily make it the worst. It's just the cheapest. It's the lowest price because it doesn't last your whole life. It only lasts a period of time that you choose, and it could last it could last annually. They have annual renewable term. They have 5, 10, 15, 20, 25, 30-year term. But typically, most people either buy 30 or 20, 30, 20, or 10, right? It's what you typically get, but most times it's 20 or 30, right? Term is great for people that have young children. And the reason why that is because, I'll just give you an example. I have a client now. She's a single mom. I just signed her up a couple days ago. She's 26, and she has 2 children, but she's single, and she's a social worker. So as we know, social workers don't make a whole lot of money, right? But she's a single mom, and so she needs a big amount of coverage. So I was able to write her. Her salary was like 40-something thousand. So we wrote her a $500,000 term policy for 20 years, and it cost her like $40 a month, something like that. But she could afford it. She had good health, but for the next 20 years, if something would have happened to her, her children had $500,000. So that was a big deal. Whereas if it was a whole life policy, that $500,000 would have been easily $300-400. You can't afford that, right? So term works really well in that situation. So I told her, like, all right, buy this $40 term policy, but then put, your extra money into your retirement, so that that money can grow at a fast rate. So at the end of this 20 years, you might not need life insurance, or if you get a raise as we go along, which she definitely will, because she's a very bright woman, but as you get raises, put that difference into a whole life or increasing your term or whatever. But like right now, that term solves that initial need. It doesn't cost her a whole lot of money, but it gives her $500,000 in insurance. So she's happy about that, right? So term works. A lot of times people diss term. Nah, don't diss term. Term is good for situations like that, right? Also, it's good for people that own a home. I had a guy yesterday. He's a client of mine already. He called me up. Him and his wife just bought a new home, and $315,000 mortgage. He said, "Look, I want a $315,000 term policy." He already has whole life. He already has whole life with me, and he said, "Look, I want a $315,000 term policy because if something happens to me, I want Chrissy to be okay." I said, "Okay," and so we wrote up a 30-year, $315,000 policy for him that matches his mortgage. So that's why it's great for people that own a home, because if you want to pay off your mortgage, you can do that. Then ideal situations is perfect for a person on a budget, but wants their kids to be taken care of financially. That goes right back to the earlier example I had with Dominique. Like that worked for her because she didn't have a huge budget, but she had a huge need though. So next is 4 reasons to buy life insurance now, though, and not wait, right? It's easy to qualify while you're young. I had a call before this call with a woman who I'm supposed to meet Friday. The meeting was already set. She called me and had a moment of honesty with me. She said, "Mrs. Smith, I know we're supposed to meet Friday, but I want to tell you something I didn't tell you on our initial call." I was like, "What's that?" She said, "I have a heart issue," and she's 49. She said, "I have a heart issue that my doctor said is terminal. And so does that affect my ability to get coverage?" Absolutely it does. This woman looks extremely healthy. She has a good height and weight. Nobody would ever know that, right? And she got it going through her childbirth. It happened when she was having her second child, right? So now, if she would have gotten coverage earlier, she wouldn't have this issue. But because she waited, and I don't know her circumstances, I'm just using it as an example, but you just never know, right? And so when we meet Friday, where she's not going to be able to get anything more than $50,000, nothing, but she's still 49. So with decent height and weight, nothing wrong with her, but the legacy that she wanted to leave, she's not going to be able to do, right? So you just never know what can happen to you, and so it's easy to qualify while you're young. Get it now, take care of it. Even if you ain't got kids, just get it, take care of it. You ain't got to never worry about nothing ever again, because you're never going to pay lower than what it will be at the current age anyway. That leads me to point number 2. Cost is much lower now than when you're older. You just save tons of money, right, if you do it now. Because a lot of times people wait till they have kids, but kids are expensive. So why throw double the cost when you have a kid than it would be if you do now? Like, so say, for example, now, just example, if you bought a whole life policy, it was $100 a month now, and then when you have then you have a kid 5 years from now, and now it's $200. So now you're paying $200, even though you plan on having a kid, you're paying $200 more. $100 extra in insurance now. Now that it's $200, and you got a kid now, so your bill is just doubled. When you could have just taken care of that when you was younger, and then you would have had the cash value built up in that meantime, and you still got a lower cost when your kid comes. So it just makes sense to have the foresight to act now, even though the pain is not there. And that's something that we talked about actually yesterday. We were talking about the Jews and their wealth. Is like that one of the principles they teach is how to accept pain now for further. Not accept, basically delayed gratification. Because ultimately what this is delayed gratification. You ain't got the need, but you know you need it. So just do it and don't wait. You know what I mean? Like just don't wait. Um, the next thing is protection from future expenses. Same thing with the delayed gratification. Even if you don't have a house yet, you're going to. So go ahead and get a $500,000 term policy now, so that whenever you get that house that you dream of, you paying it for at a lower cost, right? Just the lower cost. It makes it better to do it now. And now you don't got the expenses you're gonna have when you have children. Like children are not cheap. You know, so if you can get used to living with the policy now, you'll be far better off. And you can afford it now because you ain't got no kids, you ain't got, you know, especially if you're young. So start now. And you can always convert to a whole life later on if it's still an option, or you can always increase your policy later on if you need to. But if you start now, you always got a baseline at a lower price. So, you know, so you can always convert. So those are the reasons why you should start now. Just to recap. You qualify while you're young. It's easy to qualify because your health is probably better than it ever will be. The cost is much lower now than when you're older, and you protect yourself from future expenses, and you can always convert. So bottom line, buy life insurance now. Next thing, have a conversation with your kids and your parents about legacy. The reason why I put kids and parents in there is because a lot of times, us as millennials, a lot of times we don't talk to our parents about this stuff. But if you don't, I'm telling you, your parents will be a big bill. Trust and believe. I've seen it so many times. So have that conversation with them about legacy, because you want to make sure they got policies. Like you can get policies on your parents. I can help you with that, because it ain't nothing worse than having a $20,000 funeral cost bill coming your way unexpected on top of the grief that you're feeling. You know, so avoid that by making sure you have that conversation with your parents, making sure they got their life insurance set up. And then if you got kids, start young, talking to them about legacy and life insurance and stuff like that. So when they're 18, like the kid that was at Maryland with me, they know and they're confident and they already know, they're already making decisions thinking about legacy themselves. Because it don't matter if you're leaving somebody 10,000 or 100,000 or $1 million. The conversation is important because somebody could take $10,000 that they get intentionally, and they know that like, yo, my mom or my dad, like they gave everything they could to give me this 10 grand. They can take that and flip that to $1 million like with no problem. Whereas with a kid that didn't have that conversation, get $1 million, and they going to Miami, they going to Vegas, like off the Miami trip. You know what I'm saying? They meeting a chick in Miami, in Vegas and taking her to Hawaii. Like it's just, the money can go real fast. And so the bottom line is have that conversation with your kids, have that conversation with your parents so you won't get no emergency bill. And, you know, let's start leaving some wealth. Next thing I'm going to do is just open up for some questions. Let me see here. Does anybody have any questions? Is there one factor that will help me determine if I need whole life versus term? Yeah, it depends on how old you are. One, well, the main thing will be how and one thing that I use is, are you maxing out your retirement? Like that's the one thing. If you're already maxing out your retirement, then I will say, all right, let's go whole life then. Because the thing is, if you putting 15% into your retirement, you're gonna have a huge nest egg when you retire, you know. And so it's cool. My thing is you should max out your retirement and then get a big term policy. Once you max out that retirement, then you go and get that whole life policy. That's my rule of thumb when I'm talking to clients. I hope that answered your question. Are there any cases in which a person cannot get life insurance coverage at all? No, there's something called guaranteed life insurance. And what that is a life insurance application where you can just put your name, your date of birth on there. But those policies are extremely expensive and they're And then they're not, in my opinion, I mean, unless you really, really need it. Like this lady that I was just talking about earlier, she's probably going to need that, you know. But I gotta really get in the woods with her and figure out, you know, what's her vision, you know. But the max she'll be able to get is 25,000, and if she dies in the first 2 years, all they're going to do is just pay her back her premiums. They're not going to give her the full 25,000. So those guaranteed universal life, I mean not guaranteed, guaranteed life insurance policies are in existence for anybody, but they're not going to pay out the first 2 years, and they're capped at how much coverage you can get. And actually, yes. So actually, no. And you have to be 50 and above to get those policies. You can't be 30 years old with health issues and get them. You got to be 50 and above. So if you're 50 and below and you got major health issues, then you're kind of out of luck, actually, to answer that question authentically, Jamaris. Hold up. Can missing a payment on any type of policy void the policy when it's time to pay out? It depends on the type of policy. So with a term policy, right, that can happen even though they give you a grace period. If you just miss one, like say you've been paying on the policy for 20 years and you miss your February payment and it's like the end of March you haven't paid, then yeah, you're out of luck in that case. But if it's a whole life policy and you had it for 20 years and you got $30,000 in cash value in your policy, you can go 6 years without making a payment, and that's just an estimate. You can go 6 years without making a payment because the payments are going to start coming out of your cash value, and so what's going to end up happening is your death benefit will reduce, Kenny, but your policy is going to still be paying for itself automatically. So with term policy, the answer to your question is yes, that can happen. With whole life, it can happen, but it's going to happen at a longer, like it's going to take a while, especially if you had the policy for a while. Does that answer the question, Kenny, all the way? Okay, cool. What are the steps if someone wants to become a life insurance seller? What is the difference between a broker and an agent? So the steps of becoming a seller in a life insurance, you just got to get your license, and then you just got to link up with a broker, right? And so that's the first thing. You got to take your state test. And so whatever state you're in, Jamaris, you're in North Carolina, so you gotta go to North Carolina, see what their see. Some states require you take a class, some states don't. But I recommend you take a class before you take the test. All states you gotta take a test. Some require a class before the test, and then once you pass that license, then you become a licensed agent. But after that, you have to sign up with a broker, and so a broker is someone that's able to sell different policies from different companies, right? And then once you do that, you'll be able to sell policies as an agent. That makes sense. Does that answer that? Okay. How does buying insurance on an older family member work? Is that a whole life policy? Tasha, can you go into more details with me? Like, what's the, when you say older, like what's age? What age are you talking? Okay, yeah, dang, they right on the brink, right? So thanks for asking this question and then putting the age in there, because most carriers, they treat anybody 65 from 18 to 65 differently than they do people 66 and up, right? So most carriers, you can get standard life insurance for people that are 65 and below, right? So in this case, with a 66-year-old, a 66-year-old will more so be towards the final expense side of things, unless that 66-year-old family member had like perfect health and was okay with taking the medical exam, right? So in that case, the person, and again, it depends on their health, a whole life policy would probably be the recommendation. How's the person's health, Tasha? Do you know? Just blood pressure. All right. So if they're okay with taking a medical exam, then they can get the standard policy. And what I mean by standard, they can get, upwards of 250,000 and stuff like that. But if they don't want to take they don't want to take a medical exam and it's slightly overweight, then they would do what's called a final expense policy. They'd probably be able to get up to $50,000 with no problem. It'd be easy to do. All you got to do is like contact me or another insurance agent will contact me and get a $50,000 policy. And all they got to do is, just a simple app. The worst thing that might happen is they might do a telephone interview, but it should be pretty quick too. It can be approved in little to no time. If you want to talk about it offline, we could talk about it for certain. But it'd be a pretty easy process. Any other questions? When you don't have a will, the state takes over your estate. I've never seen that happen. That's a very complex question, but I don't believe so. But again, that question I'm not 100% sure on. But it does that conversation. But that question does lead back to what I was talking about earlier about those conversations, because it don't matter how much life insurance you have, you got to have conversations with your beneficiary, because if a person dies, they should know, the beneficiary should know that the policy is in place, so that the state doesn't take over the life insurance. And I don't believe the state takes over the life insurance. You just got to claim it. Once you say, "Oh, that's my policy," the company will. The insurance carrier will pay the claim out. So yeah. Yeah. Okay. Yeah. I don't think they can. Life insurance is different. The state can't. The beneficiary trumps everything when it comes to life insurance. I do know that. No matter what's in the will, no matter whatever is there, the life insurance beneficiary trumps everything. So I can't see how the state will be able to do it. Okay. Yeah. And that's a good point you just brought up, Jamaris. Yes. So when I first started selling insurance, I was giving bad advice. I would tell people to make their kids their beneficiaries. But it wasn't until I started partnering with an estate attorney, and she just gave me game on, like, yo, like, you realize that if a person dies, like, so if you're on here and you have children, right? You need to do your estate plan, and then two, you need to make sure that there's somebody else that's outside of that's not a minor, that's on your policy, that they can distribute the funds to the children. Because if you're like, for me, I'll use me as an example. My daughter's 4, right? If I have her as a beneficiary, she's 3. If I have her as a beneficiary and I were to die, the courts will take over that money until she's 18. And so whoever's the next in kin, that if they want to say they want to use the money for her, they got to go to the court and request and show why the money that they're requesting makes sense for her well-being. Whereas if I had a trusted person on top of my estate, they could do that. So rather than have to go to the court. So that's a good point. Thanks for bringing that up, Jamaris. Any other questions? Talk with someone. Okay. Kenny, you got another question? All right. So yeah, Kenny, good point, man. What I recommend for you, man, is I don't know if you're talking about yourself or not, but if you're in your early 30s, no kids, no house, man, I would just get a straight term policy. $500,000, $1 million term, won't cost you that much money. You're probably in tip top shape in your early 30s, hopefully. That way, when you do have the kids and all that, you got a huge term policy that you're paying a little bit of money for. And as you get the family and the kids and the house and all that type of stuff, you can adjust it and always go up. But, you know, right now, you know, $1 million term policy in your early 30s probably costs you $50 a month, something like that, 60 at the max. Well, 70 at the max, actually, because I got $1 million term policy in my early 30s, and it cost me $71 a month. And so, you know, I would recommend that. You know, maybe not $1 million, maybe 500,000 might cost you 40. You know, but that's something that can, you know, it goes back to what I was saying, that delayed gratification is like you pay it now, but the reward comes later. You know, when you have that, you have your beautiful kids and they're young, and you know you just paying $40 for a policy that's going to last a while. Like, that's a good thing, because the extra money that you saved, you know, you could put towards them, because that daycare gonna kick your ass, man. But you know, it makes more sense. You know, if you know that that's what you're going to do, man, just do it now, get it out the way, and, you know, make a lot of sense. Does that answer your question, Kenny, man? Yeah, no problem, man. Is there any other questions? All right. If not, I'm going to sign off. I'll put my email here. Yeah, I'm about to put it up there. Put my email. Yeah, if y'all could email me too, that'd be great. Yeah, so hopefully I help everybody tonight. Let's just close that racial wealth gap. There's no excuse. You know, other races are doing it on the offense. We playing defense. We got to start playing more offense. So, you know, just wanted to put that out there. And thanks, Jamaris and Peyton and Kendra, for putting this together. Really appreciate the hard work and dedication y'all put into this. All right, I'm in the meeting now.